Business owners have long asked me, Eric, why do my financial statements have to be so complicated? There's two types of methods of accounting out there. And the question is, what method of accounting do you use? My name is Eric Rourke. I'm the CEO of Rourke, and I'm here to talk to you today about cash basis versus accrual basis. Which accounting method is right for your business? First of all, what is cash basis accounting? Well, cash basis accounting is whenever you do your accounting based on cash in and cash out. So it's literally called the checkbook method of accounting. Whenever you receive cash, that's booked as revenue. Whenever you write a check and cash goes out, that's considered an expense. So just to give you an example, you may spend money on insurance and buy your insurance policy. So whenever you write that check and the check is cash, that is considered, all of it is considered an expense under the cash-based method. On the contrary, accrual-based method is very different. So instead of recording income and expense when cash comes in and cash goes out, what the objective of accrual-based accounting is to measure the income and expense when it actually incurs, when the transaction happens. So using that same example with the insurance, right? So say you write $100,000 for an insurance payment for 12 months, instead of recognizing all of that as an expense when you write the check, what you do is you do what's called an accrual, and then you recognize the expense over all 12 months. So that is accrual-based method. Very different. So what are some of the advantages and disadvantages of each, right? Cash-based method and accrual-based method. Well, first of all, cash-based method is simple. It's very easy to do. It's income comes in, expenses go out. It doesn't require a lot of accounting gyrations in order to get to the right information. Secondly, with accrual-based accounting, there's a lot of estimates and adjustments that need to be made at the end of the period. With cash basis, it's really easy. Cash went in, cash went out. You can see it on your bank statements, and your financial statements are based off of that. That's why a lot of business owners, especially as they're smaller, really prefer the simplicity of cash-based accounting. The other thing that's really nice about it is it reduces the risk of errors. I mean, with cash coming in, cash coming out, as long as you're getting that bank reconciliation done and done properly, then that should be accurate. There shouldn't be errors. And then also, if you look at it, cash basis is more adaptable. It needs less of an accounting department to operate. So you need less sophistication, you need less time, you can get the information there a lot quicker. As far as cash, from a tax perspective, is extremely nice, right? Because if you're starting to see and you're doing your tax planning with your CPA at the end of the year, what you do is you go, oh no, we're making too much income. And you start writing a whole bunch of checks before year end. It's a very common tax planning strategy. So that way you have the expenses to offset the income, and it helps to reduce the amount of tax liability, or at least defer for that year. So that's nice. There's a lot of flexibility to it. It's very simple and very easy to use. On the other hand, so let's talk about accrual basis financial statements. First and foremost, accrual basis are more accurate because you're actually matching the income and the expense in the period incurred. So I was sitting down with one business owner and we were looking over their financial statements, and they're like, oh, look, January did well, February did well, March did well. When we get to April had a loss. And so we dug into that loss and we're like, why are we showing loss? What changed or what's different? The difference was in April, there were actually, and they were bi-weekly payroll, there was actually 3 paid periods paid in April. But because they were on the cash basis, they recognized that expense when everything went out. If they were on an accrual basis, they would have probably had more expense in previous periods, and they would have definitely had less expense in April. So it causes confusion, and it's a little bit harder to really understand and really be able to read your financials because you're trying to constantly take into account these different timing differences that occur. So also, whenever you look at accrual-based financial statements, when you're doing projections, it's a lot easier to focus on that. And then you can convert that into cash-based needs because you can see where the trends are going. If you're on a cash basis with these timing differences and things like that, it makes it a little bit more difficult to anticipate and be able to know. The one thing that's really hard about accrual basis financials, though, is they're a little bit more difficult to explain because we're making all these adjustments. And if you're an accountant, great. The accountants all understand accrual-based financial statements. But when we get to non-accountants, explaining the adjustments or the estimates or the things that go into matching the expense with the period becomes extremely difficult. On the flip side, though, whenever you go to report to external parties, when you look at banks or when you're trying to sell your company, GAAP-based financials, and GAAP is generally accepted accounting principles, are based on accrual-based financial statements. So anytime that you're going to go to other parties, the common language is these accrual basis financials, because then all these timing differences come out and there's a basis that everybody understands and can compare it to. So whenever you have accrual-based financials, again, you're going to be putting those into your budgets, and then they're going to be able to match the budget to the actual much better to be able to understand the differences in your period. Look, when do you use cash versus accrual basis financial statements? It depends if you're looking at internal reporting versus external reporting. So if you're looking at cash management, cash-based financials are very easy because you've already got a basis for the cash flow in and out. But again, if you're going out to your bank or you're trying to do an audit for an M&A transaction, they're going to want the accrual-based financial statements. That's going to be helpful. And what are your growth plans? That's going to be the next question. What does your future look like? So if you're a small business and you're on cash-based financials right now, and you're looking to grow and acquire the capital, you're going to want to get to accrual-based financial statements. And then the question becomes, looking at your business or your industry, cash basis or accrual basis could be very different. If your industry really represents a cash-based flow or financial, and I'll give an example of the hospitality industry, right? Or retail, you're collecting the cash now. The thing is, though, whenever you get to inventory, it's really important. The IRS will also, at a certain point, there's a small business exemption, require accrual-based financial statements, especially if you're on inventory. So it's going to be based on the size of your business and where you're at in the curve. So C corporations, for example, or retail or manufacturing industries have inventory, and so those are going to cause differences. So if you're ready to make the change but need some assistance, we'd love to be able to help you. Also, I know there's a lot of confusion with the cash versus accrual-based financial statements. Please give us a call. We'd love to be able to help you out. If you guys got any questions, also leave them in the comments below. We'll be happy to answer that and schedule a consultation with Roy. We're here to help, and I really appreciate talking to you today about cash versus accrual-based financial statements. Have a great day, everybody. God bless.